Hello and welcome to our pre-budget Economist special. This is the show where we discuss the big budget numbers. How much may the final budget numbers differ from the interim budget? Does the finance minister need to change her revenue and tax assumptions after the excellent April-June tax collections? Is there space and need to spend more, especially after the election verdict? And finally, will the government target a lower fiscal deficit number? Joining me are two heavyweight economists, Sajjid Chinoy of JPMorgan and member of the PMEAC, and Kanti Ghosh of State Bank of India, member of the 16th Finance Commission. Gentlemen, thank you very much indeed for your time. Soumya, let me start with you. You're very busy, I know, with the Finance Commission work as well. But would you expect the Finance Minister to announce much higher, tax estimates? We just have got the April-July tax estimates, and across the board, they're like, 19-20% higher than last year. But the interim budget had only assumed about 11 or 12% rise in taxes.
Yeah, thank you, Latha, for having me on the show. No, I think just to take a little back, the prerogative of this is fiscal deficit. The budget comes against the backdrop of an impressive tax revenue and also the tax collections. But there are some things which the government used to address too, given the fact that the fiscal situation looks much better than what it was anticipated and significantly post-COVID. I think the first thing to look out for in the budget, and if you ask me, is that I think the RBI dividend numbers came it as a positive surprise to the markets, and I think all the entire financial ecosystem of around 2.1 trillion. So my sense is that while the government is committed to a fiscal deficit number, as you know that the 4.5% is the fiscal deficit number which the government is projected by FY26 as per the new FRBM targets. My sense is that the government could actually look into a tax collection in the range of 14 to 15%. Basically, the nominal GDP growth rate in the interim budget is around 11%, and I don't see any reason to change that number. If you retain that nominal GDP number at 11%, that makes a nominal GDP growth rate of around, I think, 328 trillion. So even with a tax payancy of 1.2 to 1.3, which is eminently achievable given the current trends, I think the government can target a tax revenue of around, say, 15 to 16%. So overall fiscal deficit, which was in the interim budget pegged at around 16.9 trillion, could be reduced a little bit to around 15.9 trillion. But given the fact that there is buoyancy, GDP growth has been solid, the government could still target a deficit which is lower than 5.1%. So basically, it could be around 4.9 to 5%. But at the same point of time, the 2.1 trillion could be actually used to rev up the expenditure a little bit. I don't think the expenditure could be revved up beyond a trillion.
Yeah. I'll come to the expenditure in just a minute. Let's just do revenue first. Sajjid, your take. We all know that the Reserve Bank was expected to give 80,000 crores. They gave 2.1 trillion. So there is that 1.3 trillion extra with the government. But will it be more than that? As Soumya says, he's expecting the government to have, almost 2 trillion more because of higher taxes. You agree?
I suspect it will be more. And I think the real story of the fiscal Latha over the last 5 or 6 years has been how gross taxes have evolved. Let's go back to 2018-19, before the corporate tax cut. Gross tax to GDP was 11%. That number fell when corporate taxes were cut. But because of, efforts over the last 5 or 6 years, we've seen the GST has been kind of fixed and reformed. We've seen direct taxes have been very buoyant. The base has been normalized. We expect that, last year, gross tax to GDP was 11.7%. Right? The actual numbers are now out. So we've seen, 0.7% increase over the last 5 years, despite a corporate tax cut. And my sense is last year, the government got a growth rate of about 13.5%. They were quite conservative, as the fiscal estimates have been in the last 3-4 years, very conservative, kind of under-promising and over-delivering. And so despite that 13.5%, the interim budget only kind of budgeted, 11.5% growth. I suspect that's what we'll get, that in the budget numbers that print, you'll still get conservative assumptions on tax growth. But because last year's base is higher, even if you make an assumption of 11.5% growth vis-a-vis the achieved number of 13.5%, tax to GDP will be even higher at 11.8% of GDP. So you get now higher RBI dividends and higher gross tax to GDP, even making very conservative assumptions. I think the bigger message, Latha, from this is that we come into this budget with the government having multiple fiscal degrees of freedom. And they emerge because first, apart from higher taxes, we had higher consolidation than envisaged last year. The deficit over the last 2 years has gone from 6.4 to 5.6. That means you now have less to travel. You've got to go from 5.6 to 5.1, A. Yeah. B, you've got extra cash balances with you, which means borrowing can come down. And C, you now have the prospect of higher taxes and a higher RBI dividend. Yeah. So there are multiple degrees of freedom.
Okay. No, I take your point. What Sajjid is telling us is that last year's fiscal deficit was expected to be 5.8. We got the final numbers a few weeks back. It turned out to be only 5.6%, not 5.8. And that was because the tax collections were higher by about 30,000 crores. And that clearly comes into this year by way of a base. Soumya, I'm coming to the deficit because that's the big number the markets want. They want to know if the borrowing will be less. And I know both of you are urging to tell me that, but let's come to expenditure first. There is that election result which some people interpret as anger of the lower communities. And we know that consumption was lower. Even when we looked, if we pull apart the GDP of last year, it was almost entirely capex driven. Personal final consumption expenditure rose only 4%. So is there a chance that, overall tax bracket will be brought up from 2.5 lakh to, from 3 lakh to 4 lakh or something? Or, there is more rural expenditure. Do you expect bigger changes in the expenditure front?
Yeah, thank you, Latha. I think that there are two aspects to it. One, the next budget is actually also not even 9 months away. It's in the month of 1st of February. So I think the government could actually take a graded approach to fiscal reduction and, if required, to look into some sort of a tax incentive to boost up consumption. My sense is that the government in the budget could actually look into some sort of tweaking the agricultural sector reform, some reforms in the agriculture rural sector, which is pending for the last couple of years. I think for whatever reasons that has not been pushed, because that is one aspect. The second aspect is that I think there is two types. The roadmap is also of the direct tax, the implementation of the direct tax code, and the second roadmap is that overall the GST2 implementation. So my sense is that I am not expecting too much of an leeway on the personal income taxes front. Of course, there could be some giveaways here and there, because you all know that the government is pushing us to move towards a new tax regimes where exemptions are not available. So if I take that as the benchmark, I don't expect too much amount of leeway, but of course, the government can always go for lower personal income tax regime with the caveat that you have to move towards a new tax regime. So in my sense, some changes could come in the personal income taxes front, but there could be bigger changes or a bigger roadmap for the rural economy and also in terms of some of the issues impacting the MSME sector and generating employment in the budget. And that could be taken forward in February also when the next year budget is presented.
Fair point. Well, Sajjid, your take. See, capex as it is, they have increased by about 25%, if I'm not mistaken, to 11.1 trillion rupees. And then there are some months lost during the elections. So would it make sense to really increase the capex budget? Will they even have the bandwidth to spend it in the balance 8 months? Or will there be a bigger thrust on, what a PMEAC or any other kind of agricultural giveaways?
Latha, so the question is, there's about 0.4% of GDP in extra fiscal freedom that fiscal authorities have now that they did not have or when they were making the budget in February. And the question is, how is that 0.4% going to be spent? Will it be saved and the deficit comes down? Will there be some tax cuts or will there be some more expenditure? I'm in the camp, as you were alluding to, that we already have capex growth that's implicitly budgeted to grow at 17% this year. Yeah. And, that will take some doing of a higher base. So I think there are, absorptive capacity limits on capex. If you look at revenue expenditures, X of interest and subsidies, those were budgeted to grow much more modestly. If you look at what's budgeted over the actual number last year, it's only expected to grow at 3.5%. And initially, that was the means by which the consolidation was going to be achieved. Now, with higher tax revenues and with a higher RBI dividend, the pressure of expenditures goes off. And so personally, I'd like to see higher spending on the revenue expenditure side, ex-interest and subsidies, for the reason that multipliers on the revenue side typically are higher than multipliers on tax cuts. When you have tax cuts, some of that tends to be saved. Of course, it depends on whose taxes are cut. So my sense is it'll be a balanced approach. We may get something on the tax side, something on the revenue side. But the larger point, I'll make one final point here, is, when people talk about a stimulus, we have to be realistic here that fiscal deficits are being reduced here. And so we want to make sure that we need to consolidate for sure, but we don't want to consolidate too quickly, given where private sector demand is. And here's the good news. Normally, you consolidate by higher taxes or lower expenditure. This year, because of the RBI dividend, a lot of the consolidation actually happens through asset sales, because a lot of the RBI dividend came from higher FX valuations and came from foreign interest revenue. So if you add that to what's already budget for asset sales, of the 0.5% of GDP consolidation this year, 0.4% occurs through asset sales, which is not contractionary. And that's the good news here, that we can have consolidation without compression. It doesn't have to be contractionary in the economy, and we still bring the deficit down.
Absolutely. Reserve Bank's dividend can't have come at a better time. And my sense is that they're going to give a big dividend next year as well, because people are only factoring in one rate cut from the Fed this year, which means Reserve Bank's reserves are going to continue to earn whatever, 4%, 5% invested in US Treasuries. We're going to get another dividend manna next year. But very quickly now, the big question to both of you, and if you can keep it brief. Soumya, Kanti, Ghosh, what is the deficit expected? How much can the market borrowing program go down if it goes down?
No, I think, Latha, there are two figures I should quote over here. I think I agree with the larger picture that aggressive fiscal consolidation may not be the need of the hour, given the government has comfortable fiscal space. So I expect the fiscal deficit to be, but still it should need to give a message to the market in terms of fiscal consolidation. So basically the fiscal deficit could be picked up around 4.9%, which makes it around the deficit, overall deficit in absolute numbers, lower than 16 trillion. So this would mean a net borrowing estimates to the market, which will be close to around 11 trillion, and a gross borrowing market estimates, which could be around close to 13 trillion. But these numbers actually could change if the government announces switches or other things in the budget. But my sense is that the government will go for consolidation, but at the same point of time, use the additional fiscal space to rev up the spending to some extent.
So how much does the borrowing, how much may the borrowing go down by?
So I think at 11.1 trillion, it will be lower than last year. If I remember, the last year overall borrowing was around 11.8 trillion in the interim budget.
Okay, so about 60,000 crore less.
Yes.
Got it.
Yes.
Yeah, Sajjid, your best guess.
Very quickly, I think my expectation is still that the fiscal deficit will be close to the interim number of 5.1%. But the beauty of these extra fiscal degrees of freedom is you can have all three things happening. A, close to the same fiscal deficit. B, higher expenditure. But C, lower borrowing, because as we discussed, the government had about 1.5 trillion of extra cash balances than it had budgeted. Now, I think half of that is states investing in T-bills. There's about 70 to 80,000 crore of cash balances from last year's borrowing that were not budgeted, which can be used to bring down this year's borrowing. The question is, does the government do it on T-bills or dated borrowing? That is up to them. But you could have a situation where borrowing is lower, the deficit is the same, and you get higher expenditure. So in a way, you can have your cake and eat it too.
You can do it all. Oh, you're right. You're right. We could have the same 5.1 and you could still have lower borrowing. Take a point very quickly. I mean, completely, Soumya, Kanti, Ghosh, one or two other things that the government might notice. Please make it in 10 seconds.
I think some changes maybe on the rural sector. I think some of the policy changes which are pending, the government can just say we're going to accept those recommendations and act on them thereafter.
Okay, I thought you wanted them to tax deposits less in your report.
Yes,
well as
yes,
I mean, I got that. We have to take that major point because capital gains is very contentious. Sajjid, any one measure or two measures?
Yeah, I will be looking very closely at direct tax reform and how we can migrate people to the new tax code. The fact is, over the next decade, we've got multiple expenditure obligations: health, education, the energy transition. and deficits have to come down. So the only way to square the circle, to bring deficits down, but increase necessary social expenditures, is to increase the tax to GDP. Let me give you one statistic, Latha, and end with that. Gross tax to GDP last year at 18%, center and states combined, is the highest that India has seen. So we've made significant progress on this front, but we need to do more going forward, given what we have to do on the expenditure side, on infrastructure, health, education.
Point taken. Many developed countries have 26% tax to GDP. So if you're going towards Viksit Bharat, then higher tax to GDP ratio comes with it. Thank you very much, Soumya, Ghosh and Sajjid Chinoy, for setting the tone on what to expect from the big budget numbers. We wrap up on this edition. Chartbusters coming up.